Welcome to today's explainer. If you're staring down your portfolio right now, thinking about making a big move, you know exactly what I'm talking about. Deciding to shift a huge chunk of your hard-earned money into the stock market to hit, say, a 65% equity target, it brings up a really wild mix of emotions. You've got the thrill of supercharging your wealth on one hand, and then boom, the absolute paralyzing anxiety of trying to perfectly time the jump. So today, we're going to break down the data, the psychology behind it, and the exact strategies you need to actually manage this transition without losing your mind. Which brings us to the burning question you're probably agonizing over right now. Should you just increase your equity to 65% all at once? Do you just take a deep breath, hit transfer, and cross your fingers? Well, it turns out the answer isn't a simple yes or no. Actually, it heavily depends on two totally different things: your future investment strategy and, honestly, your own personal psychological tolerance. So here's our agenda for today. 1. The 65% goal. 2. The lump sum illusion. 3. Rajesh and the long game. 4. Priya and the glide path. And finally, 5. Focus on the exit. Part 1. The 65% goal. Building long-term wealth. So why are we aiming for 65% equity and 35% in other assets? It's a really interesting balance. Experts widely consider a 65% equity allocation to be a sort of sweet spot for long-term wealth accumulation. It's robust enough to act as a serious hedge against inflation, which basically ensures your money's purchasing power is actually growing over time. But, and this is a massive but, it only works if you, the investor, can stomach the inevitable roller coaster ride of having nearly 2/3 of your portfolio riding on the stock market. And that leads us to a really critical point. The most crucial factor isn't the entry point, but the exit strategy. Getting your portfolio up to 65% equity is a great growth move, absolutely. But the real secret sauce to long-term success, it isn't agonizing over finding the perfect Tuesday to buy in. No, it's having a rock-solid, systematic strategy for reducing your risk as your actual financial goal gets closer. We spend so much time stressing about the starting line that we literally forget to plan for the finish line. Section 2. The lump sum illusion. Entry anxiety. Okay, in theory, investing is super simple, right? Got extra cash, just reallocate it to stocks. The math says just get it in the market. But reality introduces us to something called investment regret. This is that intense, not in your stomach, psychological anxiety, the absolute dread that the very second you dump a massive lump sum into the market, the whole thing is going to totally tank. It's a real, powerful fear, and it literally paralyzes countless everyday investors from making mathematically sound decisions. And because of that fear, we see people relying on what we call the lump sum illusion. A lot of investors turn to systematic transfer plans, dripping their money into the market over time to somehow magically avoid a sudden crash. But mathematically speaking, if you drip money in over 12 months and the market crashes in month 13, your financial outcome is essentially the exact same as if you just thrown it all in as a lump sum on day one. So why do we even do it? Well, the benefit is entirely psychological. Drip feeding your money just keeps you disciplined and stops you from being completely frozen by the fear of making a massive market timing mistake. Section 3, Rajesh and the long game, time in the market. Let's look at our first case study, Rajesh. So Rajesh wants to jump from 45% equity up to that 65% target, but he is completely terrified to pull the trigger. He wants to wait for a market downturn. But here's the thing. Rajesh has one massive advantage, and that number is 15. He's investing for his kid's education, giving him a solid 15-year timeline before he even needs to touch a dime of that money. And honestly, that timeline dictates his entire strategy. Because he has that 15-year runway, Rajesh absolutely does not need to wait for a crash to get started. Instead, his strategy is just to manually transfer his funds in installments over his first 1 to 6 months. Doing this completely neutralizes his entry anxiety, that fear of a sudden 10% drop ruining everything on day one. And he can sleep easy during the inevitable market fluctuations of years 1 through 5, because the data shows us something amazing. By year 15, returns tend to plateau. Basically, it just doesn't matter if he entered during a bull market or a bear market. Time in the market smooths the whole thing out. Section 4, Priya and the glide path, systematic risk reduction. Now, let's flip the script and look at our second case study, Priya. Priya has the exact same goal as Rajesh. She wants to hit that 65% equity mark. But her magic number, it's 7. She is only 7 years away from actually needing her funds, so while 65% equity makes sense right now to capture some growth, a sudden market crash a few years down the road would absolutely devastate her plans. She just doesn't have Rajesh's luxury of waiting 15 years for the market to bounce back. So let's walk through Priya's specific steps, what we call her glide path. Step 1, she jumps her equity up to 65% right now to capture those immediate growth opportunities. Step 2, she holds that exact allocation for 2 years. But here is the really genius part, step 3. Starting 2 years from now, no matter what the market is doing, she mandates a strict 5% shift of her funds into super safe bonds every single year. She is forcing a systematic risk reduction. This means even if the market totally tanks right before her 7-year deadline, the money she needs is already safely locked away.
Section 5. Focus on the exit, your blueprint.
All right, so what's the blueprint here? Let's break down the core rules for successfully making that jump to 65% equity. First, skip the overly complicated transfer plans. Just manually move your funds from savings into equity in chunks to manage your own psychology. Second, mentally prepare yourself for those quiet periods of low returns, because honestly, it's just part of the process. Third, remember that dropping a massive lump sum today absolutely does not guarantee short-term outperformance over slow, steady investing. And finally, the big one, focus on systematic exits. Hitting 65% equity is just the setup. The whole game depends on how you plan to safely exit those positions as your deadline approaches. Which leaves us with one final pretty massive question. You now know exactly how to reach that 65% equity mark. You know how to beat entry anxiety, and you understand the massive difference between a 15-year and a 7-year timeline. But looking at your own portfolio right now, are you ready to plan your exit? Seriously, don't just get caught up in the thrill of buying in. Start designing your ultimate exit strategy today. Thanks so much for joining me for this explainer, and I will see you next time.